The attorney could have done a better job.
Call Konoski Bresney at 888, the letter U, count, and the number 2, or see me on the web at bresneylaw.com.
Hey parents, you don't need the latest gizmo, slang, or clothes to be a perfect parent, because kids in foster care don't need perfection. They need you. For more information on how you can adopt, go to adoptuskids.org. A public service announcement from the U.S. Department of Health and Human Services, Adopt Us Kids, and the Ad Council.
You're tuned in to Money Matters Boston, 1120 a.m. WBNW. This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston, the Money Matters Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
I was 24 when I had a stroke.
I was 35 when I suffered a heart attack.
I was 46.
I was 62.
It's a fact. Cardiovascular disease is the leading cause of death in women.
But we can fight against our number one killer.
Talk to your doctor about your risk factors.
Know your family history.
Learn the warning signs and symptoms.
Together,
let's go red for women.
Visit goredforwomen.org to learn more.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
When it comes to estate planning, many families focus on taxes, but understanding how your family will receive the assets you leave behind is just as important. Cushing & Dolan are experts in elder law and have a new guide out called How to Leave Assets to Beneficiaries. The guide explains decisions that may be problematic, such as adding a child as a joint donor on a real estate property, which could expose your assets to creditors or a possible divorce. You'll also learn how trusts can be used to help protect your assets and control when your beneficiaries receive their inheritance. Call 866-848-5699 right now and ask for your free guide called How to Leave Assets to Beneficiaries. That's 866-848-5699. Or request the guide online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide out this month titled Building Your Emergency Financial Binder. And really, Mike, we're talking about, a set of documents that someone needs in the event that something really bad happens to them. And one of the questions that family members and friends always ask is, who should I call if that happens? And this binder should have that information in it.
Yeah, it's designed to be that one-stop shopping of, hey, what do I go for? Any number of different things that could happen, right? I mean, it could be an accident that lands me in the hospital. It could, unfortunately, be my passing. But you want a consolidated place where loved ones can go to try and find, hey, what are my first points of contact that I should make?
What are those points of contact that should make their way into this binder?
Well, I think importantly, tax preparation, estate planning, and financial advice are three of the big ones that I can think of off the top of my head. The problem is who does that and how spread out it is varies dramatically person to person, right?
Sure.
If I have 5 different bank accounts for different things, that is going to be more complicated than if I have a single bank account at a single place and then an investment advisor that's overseeing all of the investments. But again, your results could vary.
Folks, the guide this month is titled Building Your Emergency Financial Binder, and it has all this information and more in it to make sure that you are leaving a comprehensive guide for what happens if you're going through an emergency. Way to get this guide? Call 800-393-4001, or you can also request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, and Tucker with you, and as we sit here today and kick off another week, still no change to the status of the Strait of Hormuz, but potentially another round of talks between the United States and Iran kicking off within the next 24 hours. The timetable is a little bit uncertain. It's a little uncertain who exactly is going to be showing up, but ultimately, taking a step back, as we've said since the start of this, it's not worth paying attention to what everyone is saying, because just in the course of a day, on Friday, you get, one portion of the Iranian government saying, hey, everything's fine, Hormuz is open. You get another part saying, no, it's closed. Again, it's just not worth paying attention to what people say, and it's more important to pay attention to what people do. This is generally the approach that we take on this show most of the time, because if you pay attention to everything that people say, man, you're just going to have a really tough time getting through a day, let alone, a month or two. So ultimately, here's where things stand. Traffic through the Strait of Hormuz remains largely restricted. Over the weekend, you had a number of different instances, including, I think, quite honestly, you can laugh about it a little just because no one ended up getting hurt as a result of this. Did either of you happen to hear the Indian tanker that was trying to go through Hormuz that then got fired upon by the IRGC? The captain of it?
No, what's the punchline?
No, this is not a punchline. This actually happened.
Oh.
So basically, here's what was going on. There were a bunch of tankers that were trying to go through. I think it was on Saturday morning. Maybe it was Sunday morning. I can't remember. Honestly, they all blur together. And the IRGC goes and, they've got all these, fast attack boats, and they send them out. And these tankers are trying to go through, and basically had to tuck tail and turn around because the IRGC was like, no, you guys aren't getting through. And again, it's funny because no one ended up getting hurt on it. I'm sure it's, frustrating for the captain and still scary, but the captain of this Indian tanker, maybe it was a cargo ship, I can't remember offhand. Tucker, have you heard the audio of this?
I did not, no.
So the guy literally is hailing the Iranian ships around him, and it's basically like a call to tech support or customer service that went badly, or trying to get into a party is how it comes off. The guy's sitting there, he's like IRGC boats, stop firing at me. I'm second on your list. I'm on the list. I'm supposed to be able to get through. Like, stop firing at me. And, of course, like, they didn't. And so he ends up, turning around. But, you've just got this case where, as it stands right now, even though there's been some sporadic upticks in traffic here and there, and at one point over the weekend, it looked like 20 ships were making a run at it, and then they all turned around right after this. There's just no meaningful flow of ships, and so as a result, there's no meaningful way that you get the offline production back online right now. So Hormuz remains closed. But despite that, the piece that I find interesting in all of this is, again, pay attention to what people do, not what people say. And both sides at this point have accused the other of violating the ceasefire. The Iranians have said that the blockade has violated the ceasefire. The U.S. has said that the closure of Hormuz has violated the ceasefire. And normally, when you've been shooting at someone to begin with and they do something that you say is violating terms that you agreed on, generally you'd say, okay, like, I guess we're going to start shooting at each other again. And that hasn't happened. And I find that interesting because it suggests to me that, again, for all of the public posturing and this and that continues to be the noise. The action is Hormuz remains closed, but despite each side saying, oh, like, you violated the ceasefire, no one's going and saying, okay, well, we're just going to start, shooting everything that we can at you again. Which is constructive to a certain extent. I'm not saying it's, like, good, but I am saying it's constructive. And so I think the lay of the land here is that there are at least elements on each side that want to be able to move on from this. And, I struggle to find the idea for exactly what an agreement looks like because there are, clear differences where, the U.S. wants, get rid of the enriched uranium, a ban on, further enrichment, so on and so forth. Hormuz goes back to, pre-war characteristics. Like, you can go down, like, the whole list.
It's not going to happen.
The Iranians are sitting there saying, hey, you guys, yes, like, our military is not what it used to be, but ultimately, we're controlling the Strait of Hormuz right now, and we're not just going to give that up and take the deal that you were offering 12 months ago. So the question is, what's the deal that ends up being acceptable to both sides? Which, look, in an environment where there is not a clear, decisive victory, where one party walks away and says, yep, like, I'm able to dictate terms, what you end up with is a negotiated agreement where not everyone gets everything that they want, and you have to kind of live with that. So it seems like we're heading towards something along those lines, but exactly what that looks like, I don't really know. And the other piece that I will always, continue to point out here, none of these sides trust each other. The Iranians are sitting there going, hey, we were negotiating with you twice before in the last year. Both times we were, you started shooting at us. We don't really trust you. The United States is sitting there going, hey, you guys have been, messing around and you've been launching stuff at everyone, and now you're like, Hormuz is open and closed at the same time. Like, guys, like, what are we going to do about this? Like, let's figure this out and move on. And the Israelis, remember, the Israelis are sitting there too saying, hey, we just plain don't like the Iranians. The Iranians are sitting there, we don't plain like the Israelis. And then you get all these Gulf states, the UAE, Qatar, Kuwait, Iraq, they're all sitting there going, hey, we don't really like this either. We don't really trust the Iranians to be the judge of who should be able to get, ships through back and forth. And the other thing I'll add on this, if you're the Iranians, this is kind of a one-shot deal that you have here. Because if there's one thing that all these Gulf states have learned, it's, okay, you got to have backup plans to the Strait of Hormuz. Saudi Arabia basically proved this with their east-west pipeline that they have, that they've been able to maintain some export capacity. You better believe that every single country in the Gulf is sitting there saying, okay, as soon as this is wrapped up for good, we are starting construction on pipelines to somewhere. I don't know where that somewhere is going to be, but we need an alternative that doesn't go through Hormuz. And so Iran's sitting there going, guys, we probably have one shot to do this because the situation 10 years from now, a Hormuz closure won't mean what it used to because all of these countries have realized they can't be so reliant on it anymore.
Yeah, I guess one lesson if you're an economist trying to model these things or you're a market participant trying to synthesize all this into something coherent.
Yeah.
We're in a world where supply shocks, which is what this oil, this seize up represents, lower supply, higher price. They may become more frequent, at least until alternatives can be found. And there's the geopolitical uncertainty factor as well, which is closely related. I guess one analogy is you got this, this hornet's nest like on the side of your garage, and you tell the kids, just don't go near it. And we finally, bashed it, and now they're all over the place. I don't know of a better analogy. I'm sorry, but my point is, for a while, it changes a lot of patterns. You've disturbed something that was there for a while. You had this sort of understanding with, but you decided to go in full bore. And now you've got to deal with the short-term consequences. Will we be better off in 5 years? Possibly. But if you are, again, worried about inflation perking up from time to time as a result of supply shocks, that's more likely now than it was before. And disturbances to capital markets that are maybe knock-on effects of that are more likely, at least in the short term. I mean, suppose this goes on for a couple years. We come to an agreement, then they renege, we go in again.
This is the problem that you potentially get to is, remember, in a negotiated agreement, everyone walks away being like, I got wronged. Like, no one feels good after a compromise. I mean, think about, you compromise with your kids about something, and you're like, I can't believe I had to give ground on that. And your kids are like, can't believe Dad's such a hardo. Like, what's the deal? No one feels good after a compromise. And especially when you're talking about billions of dollars at stake and control of your economic destiny, and all the Gulf states are sitting there going, hey, everything was fine before this. We might not have liked these guys, but we could make our money and we could kind of go about our day.
That's my hornet's nest.
And now they're sitting there saying, okay, so you're gonna have some level of control, or you're gonna none of these states liked Iran to begin with. The Qataris put up with them just because they would, be able to facilitate some deals. But you go through the region, no one liked them. It was just nope, not interested.
But we lived with it because you had to.
You dealt with it because it was okay, as long as we can keep making money hand over fist, who cares? We all have neighbors that we don't like, as long as it doesn't affect our livelihood, okay, fine. It's one thing when they're, sending a lacrosse ball into your house. It's another when, the neighbor shows up, drunk on your front doorstep, pounding the door. It's okay, we've gone too far now. So, yeah, you might have, recurrences here. And the issue that you get to if that happens is, think about this from a business perspective. And again, this is what ended up happening in the 70s. The way to avoid a 70s style, not inflation, but a 70s style problem with productivity growth is to have this be done and dusted and move on. If companies have to build in additional resilience, that directly impacts productivity because now you can't make as much for the same number of inputs. You have to be storing extra inputs and, building up backups and this and that. You can't be as agile and as lean as you want to. So where this goes short term, I got no idea, but again, things seem to be pointing in the right direction despite all of the noise over the weekend. Ignore the noise, focus on the signal. Longer term, next 5-10 years, could things flare up again? Maybe. I have no idea, but these are not exactly groups that get along well in the best of times. They've been through a decent amount in the last couple months. They're all going to come out of this, with their hackles up and all ready for something else. And so it's not exactly the most stable long-term equilibrium, but you'll just have to see how it goes. Let's take a quick break. When we come back, let's talk a little bit about what we're seeing with stocks after this.
Market insight, retirement strategies, real talk about Wall Street and economic trends. All live every day on our YouTube channel. Go to youtube.com/The Financial Exchange Show. This is The Financial Exchange. When it comes to leaving assets to your family, simplicity isn't always the best approach. Cushing & Dolan are experts in elder law, and their new guide is called How to Leave Assets to Beneficiaries. Adding children as joint owners on accounts or property doesn't guarantee you can avoid probate. It may create serious unintended consequences. In this guide, you'll learn why leaving assets to your children may not always be the best plan. The guide also explains how trusts can be used to stagger distributions over time, help protect assets from creditors or divorce, and ensure your family receives your inheritance in a way that makes sense for your personal situation. Call 866-848-5699 right now and ask for your free guide, How to Leave Assets to Beneficiaries. That's 866-848-5699. Or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Organization can make a big difference when life takes an unexpected turn. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Having your most important information all in one place may help the people you trust handle critical financial or legal decisions if a crisis occurs. We've written a new guide called Building Your Emergency Financial Binder. In it, we offer strategies that can help you coordinate the most vital details of your life, including key contacts, legal documents, and property information. Our goal is to provide you with a clear plan for the people you trust if they ever need to help manage a life-altering situation. Call 800-393-4001 right now and ask for your free guide called Building Your Emergency Financial Binder. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive. Most of the time, it's because no one nearby performs CPR. Every walker who joins HeartWalk means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Find your local HeartWalk at heartwalk.org.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Our Senators Edward Markey and Elizabeth Warren and Representative William Keating are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
I normally do that.
All right, let's talk a little bit about what's going on with the stock market, as it's referred to. So here's the deal. Stocks are at all-time highs, and you got a whole bunch of people hand-wringing, being like, oh, how can stocks be at all-time highs when there's all this uncertainty? And I'm not saying that, like, you're right or wrong, because the next few weeks we're going to find out who's right and who's wrong. This is not like a victory lap, but what I am saying is the same thing I've said since last week, which is if you owned stocks last summer, and you were comfortable paying 22 times forward earnings for stocks, then today when stocks are trading, and stocks, I'm talking about the S&P 500, if the S&P 500 right now is at 20.9x forward earnings, which it is according to FactSet as of last Friday, then if you were to do the simple math, you would find that stocks are 5.2% cheaper relative to earnings now than they were throughout most of last summer and into last fall. Now, there's a case to be made that until the situation with Hormuz fully resolves, stocks probably should still be cheaper on a valuation basis because this is a new question that wasn't present last year, and so that's cool. But ultimately, if you believe that earnings are going to grow the way they're projected to grow, and you believe that stocks should be valued, somewhere in the ballpark of where they were last year, then right now with the S&P 500 at 7118, you've got easy upside to the 7,500 region based on the fact that earnings estimates have grown over the last 6 months while the S&P has basically gone nowhere until the last couple of days. So this is, in my opinion, if you want to believe the path to stocks going higher, it's that earnings projections have continued to grow. Not only that, but earnings, actual received earnings, have been better than expectations as they normally are. And so ultimately, if the Hormuz situation resolves, there's not really a whole lot of stuff in the way to say, yes, stocks can move higher from here. Now, if you want to sit there and say, Chuck, that's all well and good, but I don't think Hormuz is going to resolve, and even if it does, it's still going to cause problems in the economy, blah, blah, blah. Fine, totally get that view too. Again, I'm not here to say either one is going to or not going to happen. But the great thing about markets is, hey, if you've got a view that you want to express, there is a tool to allow you to express that view. You think stocks are going to 7,500? Great. You can buy them. You think stocks are going to 5,500? Great. You can sell them. There's nothing stopping you from doing that. But I do think this is somewhat of a binary market in that I don't think that there's like a ton out there where you're like, well, maybe stocks fall like 5 to 7% from here, and that's, kind of where they are, for a while. What's the path there? I don't quite get that. I understand the path to future upside this year, and I understand the path to like a 20 to 30% pullback this year. I don't think there's a viable path where it's like, well, stocks are just going to have a modest pullback and just hang out there. Like, I don't get that. But these are kind of the two paths that are out there, I think, if you want to look at markets today.
It's not really surprising that stocks are up. They tend to go up because the economy tends to grow. If you drop yourself into any period in history, any day, any hour, and you had to make a bet, you should say stocks are up today. Stocks are up this year. And if you
not today, because today's a 50-50 principle. Today's basically a 50-50 bet.
on a daily basis, it is.
It's like 51, right?
Yeah, well, not even, but close. But you compound that, and it's powerful. Yeah, you could, if you, as a rule of thumb, stocks are up a little more than half the time on a daily basis, about 60% of the time on a monthly basis, and about 70% of the time, or a little bit more than that, on an annual basis.
Yeah.
The trend is up because the economy continues to expand. It is not really remarkable that stocks are up. You could have your own opinion about why they should be down, but globally stocks are up. The ex-US global index is up about 10.5% this year. I'm rounding up just a tiny bit. US stocks are up about 4.5%, rounding up just a few fractions of a percentage point. So you could say US stocks are sagging relative to the global stock market. I wouldn't put it that way, but one could. So again, I don't think it's surprising at all that stocks are up because the long-term ramifications of what's happening in the Gulf are unclear.
I do think this is a pretty pivotal couple weeks. Just again, since the beginning of this, those of you who have been listening the last couple months, Cinco de Mayo has been my line in the sand, where if there's no resolution by then you can't really have a Cinco de Mayo party, because things start to get pretty gnarly for the global economy. But we still have a couple weeks to get there. So let's see how things develop over the next couple of weeks here. Quick break. When we return, it's Wall Street Watch.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up.
Because we have something better.
Stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
Sudden family emergencies can create confusion, especially when important information is scattered across different accounts. Hi, this is Mike Armstrong from the Armstrong Advisory Group. When something unexpected happens, loved ones may need quick access to legal documents or financial accounts that could affect your future. Our brand new guide is called Building Your Emergency Financial Binder. It'll help you learn how to organize the information your family may need one day. Everything from emergency contacts and identification documents to bank accounts and retirement plans. The goal is to create one clear roadmap so that people you trust can quickly find what they need if a crisis occurs. Call 800-393-4001 and request your free guide, Building Your Emergency Financial Binder. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, how can you ensure that your kids' inheritance can be protected from future divorces?
Well, estate planning, as you know, does things like avoid probate, protect assets from nursing homes, and reduce taxes. But you know what? The family behind the estate plan can be more important. And so the trusts live on after you die, and you can have language in there that divides the assets to the children, but doesn't just pay it out, right? It holds it in trust for them and allows them to be trustee, but just not take it. In order to get it, they have an independent trustee that can say yes or no. And that way, by not owning the asset, if they get divorced down the line after you're dead, and the other side says, hey, I want half of what's in that trust, you're going to say, that's great, but you have to ask the independent trustee. So it's now not going to be available to you. And more than just the ability to say no, it's the fact that you don't own it. So if you don't own it, it's not a marital asset to begin with, so it should not be even subject to the divorce. So learning how your trust works after you die can oftentimes be more important than when you're living, and it does more for you after you die than when you're living sometimes.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699. 5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets are down modestly despite tensions between the U.S. and Iran increasing over the weekend after the U.S. seized an Iranian ship and maintained its blockade of the Strait of Hormuz, causing uncertainty around the second round of peace talks. Right now, the Dow is down over 0.1% or 74 points lower. S&P 500 off about 0.25%. NASDAQ down over 0.4% or 113 points. The Russell 2000 is up 0.2%. 10-year Treasury yield up 1 basis point at 4.262%. And oil jumping over 4% higher, trading at $87 a barrel. Shares in American Airlines down over 4% after the company shot down rumors of a possible merger with United Airlines, saying it was not engaged with or interested in any discussions regarding a merger with United. Meanwhile, shares in Marvell Technology rising 4% after the information reported the chipmaker is in discussions with Google to build new AI chips. Broadcom shares falling 2% on that report after it recently agreed to produce future versions of Google's AI chips. Building products distributor QXO agreed to acquire insulation products company TopBuild for $17 billion. TopBuild stock is surging 16%. Eli Lilly agreed to buy cancer drug maker Kelonia Therapeutics for as much as $7 billion. I don't know why that was so hard. Eli shares are dipping. And tomorrow morning, ahead of the opening bell, we'll see first quarter earnings from GE Aerospace, United Health RTX, and 3M. I'm Tucker Silva, and that is Wall Street Watch.
It's nice to know that on a day when Mike's not here, we can still mispronounce medical names.
I'll get there
on the show.
Maybe next hour I'll fix it.
No, keep it the same.
That was good, if you ask me.
It was fine. Let's talk a little bit about this piece from the Wall Street Journal. It's titled, Kevin Warsh pitched a case for Fed rate cuts. His future colleagues are skeptical. Mark, can you outline the case that Warsh has pitched before we go further?
Can I compare it to the late 90s?
Well, I think Kevin's trying to, so...
Yeah, so Green, let me just start with... I'm sorry to start with a little history here, but in the late 90s, there was a mystery. How can unemployment be so low and inflation be low? Why isn't inflation ticking up? Unemployment seemed to be below the natural, if you like, rate. In sort of general terms, textbook terms, when unemployment is too low, the economy's running too hot, inflation should be accelerating. That wasn't happening in the late 90s. Greenspan speculated, a lot of people thought, but he acted on this conviction, that it might be due to increasing productivity.
In the late 90s, we were down around 4% unemployment, right?
Excuse me. Yeah, for the first time in a long time. And people were very worried.
1960s,
late 1960s.
Yeah.
So by conventional thinking at the time, that was indicative of an economy that was running way too hot, almost surely to put upward pressure on inflation. The normal thing for the Fed to do would have been to tighten policy. Greenspan said, let's wait and see. This could have something to do with productivity. I'm oversimplifying a little bit, but that's the gist of it. So Greenspan didn't argue that rates should be cut. He simply argued that, unemployment in the fours, which was an historical... It was an anomaly, at least at that time, relative to the experience of the 70s and 80s.
Sure.
He said this might be due to more or less the computer revolution and the related internet revolution. And in retrospect, he was right. We didn't know it at the time, but productivity was soaring, and that did help to keep the cost of that did help to keep real wage growth modest and thus inflation down. Warsh is arguing this time that because of the prospective, hasn't happened yet, boost of productivity from AI, or at least isn't strongly evident from the data, conclusively evident from the data, that we should be cutting rates when rates are already in real terms, after inflation terms, quite low, lower than anybody thinks is consistent with the neutral level of interest rates. So Warsh is making a much more aggressive argument than Greenspan made in the late 1990s.
When we talk about productivity, effectively, remember, like when people talk about like how productive they were at work, they're not talking about it the same way that economists talk about it. Economists are talking about it in terms of, hey, how much output can you produce per units of input, basically?
Output per hour.
Yes.
Yeah.
Yeah. Output per hour, yes, is how it's typically looked at.
Yeah.
So one of the problems that we had in the 2010s, along with, a few when it related to the economy, productivity growth went in the toilet in the 2010s. We did not have a single year in which productivity growth was north of 2%. It was consistently averaging somewhere like generally between like 0.75 and 1.25% is where it spent most of the time in the 2010s. There was just no productivity growth. You contrast this with what we saw in the late 1990s, where productivity growth was consistently running around 3%, generally between like 2.5% and 3.5%. And so the question in the 2010s that people were asking was like, hey, why is there no productivity growth? I still don't have a great reason for that, but let's put that aside. What is interesting is that in the last 3 years now, productivity growth has been better than what we've seen in the 2010s, but not as strong as what we saw in the late 1990s. It's generally running around 2 to 2.25%, which is still good. It's much better than it's been. And if you were to look at, kind of what we've generally seen historically, it's a pretty decent number. It's not like outstanding or anything, but it's not terrible. It's not, the 2010s. So I think the case, and correct me if I'm wrong, Mark, the case that Warsh is making is that as AI gets deployed into more businesses and we understand how to use it better and it gets more powerful, that productivity growth should grow from the low to mid twos to higher numbers, whether it's 3%, 4%, whatever it might be. Like,
that's a very bad argument.
That's what he's saying should happen. Why is that a bad argument compared to what Greenspan's argument was? Like, can you contrast them?
Greenspan said at the time the puzzle of coincident very low unemployment and very low inflation is attributable to a spike in productivity, which is in turn attributable to the technology revolution.
Sure.
The fruits of which were realized on a widespread basis in the late 1990s. Because there was pressure on Greenspan to raise rates at the time because unemployment was very low.
Before we go further, has there been any research done on that to confirm that specifically that was the key driver? Or, like, just as an example, one of the major themes going on then as well was globalization and outsourcing stuff to be able to make it more cheaply. Do we have any research as to what actually caused the productivity boom?
Yeah, lots. It's a very fruitful. It's something that's very widely researched. And the long and short of it is, the consensus is it was productivity, not globalization, because globalization was a very long-term phenomenon.
Sure.
The economy was globalizing in the 70s and 80s. And so there are some other problems with attributing that to imports that I won't get into.
Okay.
But the consensus is it's productivity. But again, what Warsh is saying this time is let's assume there will be a productivity boom. At the time Greenspan made his argument, it was again to hold rates steady, not to cut them, to hold them steady when there was pressure to raise them because everybody thought unemployment was too low and thus would be inflationary. Warsh is saying there might be a productivity boom at some point, so let's just change policy now based on that prospect. Those are two very different arguments.
So, to summarize, just to make sure that I'm understanding clearly, Greenspan's comment, or not comment, but thesis was unemployment is low and we're not seeing any type of uptick in inflation, so we can afford to be patient and not raise rates despite the unemployment rate being in an area where
he correctly
we
identified the mechanism that was
happen.
at work there. Yeah, don't forget about there's this short-term trade-off between inflation and unemployment that the Fed pays close attention to. The nature of that trade-off, the shape of it, if you will, changed in the 90s. A lot of people realized it, but Greenspan had the conviction to let that influence policy making.
Let me ask another question just on this. So if we take a look at where the Fed funds rate is at this very particular moment in time, Fed's holding it at 3.5 to 3.75.
Yeah.
let's assume that Warsh is right. I'm not saying that he is or isn't, but let's just do a thought experiment. Let's assume Warsh is right. What's a reasonable case for how low the Fed could take rates if he is?
Well, there'll be a neutral. There'll be the neutral rate will change if he's right. Suppose it's 1% today. The neutral rate being the rate that effectively keeps inflation steady, all else equal.
Sure.
If there is this productivity boon due to the widespread adoption of AI, that could actually push the neutral rate up, not down. The New York Fed and others, Richmond Fed, publishes a regular update on the neutral rate. It's somewhere in the 0.75 to 1.5 or so range.
And that's above
today.
Above inflation.
That's the real. Thank you. That's real. Real rate today, by the way, is about 0.5 if inflation's at 3. So policy may be loose today. He wants to loosen it further based on the prospect. Sorry, Chuck.
So I guess where I'm going with this is, if one were to assume that Warsh is right, there's not a path for the Fed to cut rates from like 3.5% to 1.5%.
No, because that AI investment requires capital, and that will push up interest rates. More demand for loans, right? So the neutral rate may go from 1 to 2.
So here's where I tend to land on this. Is, look, quite honestly, like let's also assume like Warsh gets confirmed and yada yada. If Warsh wants to cut interest, like all else being equal, if he wants to cut interest rates by 0.25% or 0.5%, I don't really care. It doesn't make a difference.
Personally lose sleep, no.
What ultimately matters is the magnitude and direction of the change. And if you're just going to do a rate cut or two, it's probably fine.
We'll know in a year or so if he's wrong, and they'll have to change course.
But ultimately, it's like, everyone gets so like, oh, is the Fed going to cut by 0.25%?
Yeah, I agree.
It doesn't matter if the Fed cuts by 0.25%. What matters is, hey, are they going to have to like move directionally like 0.25% for 6 meetings in a row, or are they generally in the right ballpark?
I agree.
0.25% here and there doesn't matter.
In the 70s, they systematically erred for like several years.
Yeah.
I think they'll course, if Warsh, because of political pressure, holds steady on rates or decides to cut them, we'll know. If that ends up being the wrong thing to do, we'll know it within a year to 2 years, and the Fed will have to dramatically change course.
Let's take a quick break. When we come back, we'll talk about, hey, if you're a worker and looking for a new job, why are you so stuck right now? We'll discuss that when we return.
Subscribe now to our YouTube page, where you'll find daily interviews and full shows of the Financial Exchange. We'll get you caught up on anything and everything you might have missed, right here on the Financial Exchange.
Hi, this is Susan Powers from the Armstrong Advisory Group. When it comes to Social Security and Medicare, the decisions you make today can have a lasting impact on your retirement. There are key choices to consider, like when to claim, how spousal and survivor options work, and whether your Medicare coverage is aligned with your needs. And without a clear strategy, it's easy to overlook how taxes, income, and healthcare costs all connect. So join us for a complimentary educational seminar on Thursday, April 30th at 5 p.m. at the Crowne Plaza in Woburn. We'll help you understand your options and the decisions that come with them. That's Thursday, April 30th at 5 p.m. at the Crowne Plaza in Woburn. Reserve your seat today by calling 800-393-4001. That's 800-393-4001, or register online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Leaving assets to your family may sound simple, but you need the right plan. Cushing & Dolan's new guide is called How to Leave Assets to Beneficiaries. Protect your assets and control your family's inheritance. Call 866-848-5699 and request your free guide today. That's 866-848-5699, or request the guide online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, adjutant of the Disabled American Veterans Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Our Senators Edward Markey and Elizabeth Warren and Representative Ayanna Pressley are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play the Financial Exchange. This is the Financial Exchange Radio Network.
The Financial Exchange is incredibly proud to be a partner of the Disabled American Veterans Department of Massachusetts. Nearly 400 runners have already registered for this year's DAV 5K. The event sold out in record time last year, so head to dav5k.boston for all the information about how you can participate this November or make a donation to support our great American heroes. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston.
Why are workers stuck? Not enough employers is the headline from a Bloomberg opinion piece, and basically it's saying, hey, you've got a situation right now where there's very little turnover in the labor market, and you're just seeing a situation where, again, low turnover and not much job hopping relative to what it's been in the past. And the case that this piece lays out is, hey, if you don't have another firm to go to, then you can't get a higher offer to either leave or bring to your current company in order to get them to raise your salary. And it's an argument that I'm sympathetic to because I'm a big believer in, look, we could have a whole lot less regulation in the economy if we just had a lot more competition, because competition forces change better than regulation, in my opinion. It's that need to compete for either business or for workers or for inputs means that companies have to always be evolving and always trying to do better for customers or for their employees, or they risk losing them. If there's only one game in town, you don't have to compete for customers, you don't have to compete for employees, you don't have to compete for resources, and so you get kind of, I think fat and happy is the technical term. I'm not sure that I've seen enough data to suggest that this is actually what's going on here, though, but it is a view that I'm sympathetic to.
Yeah, this comes from a paper, a very dense paper. I got through like the first couple of pages and said,
if you're telling me it's dense,
it is dense.
It's dense.
I mean, papers in economics, I mean, you got to have either a math degree, undergrad, or a graduate degree in economics to understand them.
I have neither.
I'm getting through. Well, you're pretty smart though. Between your instinct and Gemini, you could probably figure it out. But there are some things that even a very smart person would just find totally inaccessible. I got like there were 2 pages.
Yeah.
And it's so damn specialized that I just sort of gave up and said, Gemini, can you summarize this?
Yes. Tell me what this means.
Yeah, pretty much. I just sort of I'm like, I could spend a half hour trying to derive this the main equation of the model, and a lot of it is theoretical. So beware. The idea that mobility or lack thereof due to more concentration might be the culprit behind the very... Okay, what's the puzzle? Every paper starts with, what are we trying to explain
It's
here?
a hard maybe.
What are we trying to explain here? We're trying to explain the fact that real wages doubled from World War II to 1970, and then since then, in the 50 years since then, more or less my whole lifetime, they've only gone up by a quarter of a percentage point. Whoa, what's the reason for that? Is it technology? Sure. Is it trade? Is it concentration?
Yeah,
they say it's concentration, which is interesting, Chuck, but there's going to be a lot more, obviously, work on this.
Well, it also then gets to the question of, what is an appropriate sample size for the duration that you're measuring? Because, what they lay out is true. Real wages have been kind of stagnant for that period. But if you look at the last 5 or 6 years, and not 5 or 6, if you look at the last 4 now, basically since inflation peaked in 22, real wages have actually moved up pretty constructively over the last 4 years, and this is one of the most concentrated economies that we've ever had in the United States. So, what do we make of that? Is that period enough to, either prove or disprove this? I don't know. I haven't done the research. But, look, over a single quarter, it can be noise. But you start looking at something that happens over 4, 5, 6 years, and you're like,
oh no, we're 50
okay,
years into this is real.
I know that we're 50 into that, but this new real wages in the last 4 years have actually moved up at a decent clip. It's kind of gone against what we've seen, for the rest of that time period. So I don't know what to make of that. Again, I'm sympathetic to the view outlined in this piece, just because my general preference is, hey, you can regulate the economy a lot less if you allow for more competition, because if a company does bad stuff that people don't like, okay, they're going to lose their business and lose their employees. If the only companies in the world are Amazon, Apple, and Google, well, they can kind of do whatever they want, because where are you going to go? Who are you going to call? Ghostbusters? No, you're not, because they're out of business too. Let's take a quick break, and when we come back, we got more financial exchange in just a bit.
When it comes to estate planning, many families focus on taxes, but understanding how your family will receive the assets you leave behind is just as important. Cushing & Dolan are experts in elder law and have a new guide out called How to Leave Assets to Beneficiaries. The guide explains decisions that may be problematic, such as adding a child as a joint owner on a real estate property, which could expose your assets to creditors or a possible divorce. You'll also learn how trusts can be used to help protect your assets and control when your beneficiaries receive their inheritance. Call 866-848-5699 right now and ask for your free guide called How to Leave Assets to Beneficiaries. That's 866-848-5699. Or request the guide online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
One of the most helpful things you can do for your family is to make sure that important information about your life is organized and easy to find. Hi, this is Chuck Zodda from the Armstrong Advisory Group. Financial accounts, legal documents, and insurance policies are all part of a complete financial picture. When that information is scattered scattered in different places, it can be difficult for loved ones to step in and help if a crisis occurs. Our new guide called Building Your Emergency Financial Binder will show you how to organize the most important details of your financial life, including key contacts, retirement plans, investment accounts, and insurance information. Call 800-393-4001 and ask for your free guide called Building Your Emergency Financial Binder. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive. Most of the time, it's because no one nearby performs CPR. Every walker who joins HeartWalk means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Find your local HeartWalk at heartwalk.org.
Our Senators Edward Markey and Elizabeth Warren and Representative William Keating are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is the Money Matters Radio Network. WBNW 1120 AM and W275 CM FM. Concord, Boston. The Money Matters Radio Network.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Organization can make a big difference when life takes an unexpected turn. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Having your most important information all in one place may help the people you trust handle critical financial or legal decisions if a crisis occurs. We've written a new guide called Building Your Emergency Financial Binder. In it, we offer strategies that can help you coordinate the most vital details of your life, including key contacts, legal documents, and property information. Our goal is to provide you with a clear plan for the people you trust if they ever need to help manage a life-altering situation. Call 800-393-4001 right now and ask for your free guide called Building Your Emergency Financial Binder. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's DAV5K.Boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, why can't you just add your kids to your accounts or to your house deed?
Well, you can. It's just not a good idea. So people who do that understand with an account, right, you can put a joint name on the account. Now, that doesn't actually complete the gift because you actually have to take the money out and then the gift is complete. But when you set it up, yeah, the asset would avoid probate. But if something happens to the child, it's going to be, available. Half the asset would be subject to the children's creditor. So you don't want that. And secondly, if you only put one kid on the deed, you've likely disinherited the other kids. So it's not really good planning overall. Whereas if you put the house in the kid's name, now you've actually made a completed gift of half the house and would need to file a gift tax return, number one. Number two, of course, it's exposed to the child's creditors and, yes, divorces. You could find yourself at some point owning half your house with an ex-in-law. Not sure that's a good way to plan. So please, put together trusts. Don't just throw names on deeds or on bank accounts because, as I always like to say, nothing good comes from giving assets away while you're living.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Chuck, Mark, Tucker with you here, and kicking things off, we've got stocks kind of mixed, kind of all over the place, and everything is changing minute to minute, which is basically par for the course over the last, 7-8 weeks or so. Or, my entire life, whatever. S&P 500 is down 38 points right now. When we came in this morning and stocks opened, we were down like 5 or 6, so it's worsened a little bit on reports that talks might not be happening until Wednesday now, even though the ceasefire is believed to expire tomorrow night. I don't know. I don't know at this point. Don't ask me, but they're going to talk when they're going to talk. They're not going to talk when they're not going to talk. I don't know. The Dow Jones Industrial Average is off 129 points, about 0.25%, and the NASDAQ Composite is off 232 points, about 1% right now. Interesting thing, just when we're talking about kind of what's selling off and what isn't in tech, you've got today, the stuff in tech that's doing okay is Apple, software, and Cisco. Semis are getting hit a little bit, but not across the board. Your memory guys are getting hit more, and Intel's down 4%. But, again, it's just kind of messy, like what you're seeing even in the tech space right now. When we take a look at the bond market today, 10-year Treasury is up 2.6 basis points to 4.27%. Gold is down 59.70 an ounce to 48.19. And we've got crude oil, West Texas Intermediate, and Brent crude, both up about $5 a barrel. AAA national average for gas prices, though, is down 0.6 cents to 4.04 2/10. So we're off, from that 4.14, 4.15 range, down about 10 cents from there. Again, where gas price is going to be like a week from now, people keep asking me. My answer is, well, tell me what the status of Hormuz is going to be a week from now, and then I can, give you an adequate assessment. We are getting close to the breaking point with some of this stuff, though. Like, I quite honestly, I know that we don't really see it here in the U.S. I have a buddy over in Europe. I have a few, actually, but only one that I've talked to about this. And he continues to tell me that he's seeing more and more, gas stations that are missing one or more products on a daily basis. I have a couple other buddies who live over in Asia, and they've basically described like the scene as basically what we were doing for toilet paper back in 2020 is what everyone over there is doing for anything energy or hydrocarbon related. It's just like that's the situation in Asia right now. Japan, just as an example, has stopped publishing oil inventories in the last 2 weeks. We don't know how much oil Japan has left because they've just stopped publishing. There are two reasons that you do that. One is to prevent, panic of your population. The other is because, well, that's really the only reason why you would do that. Again, Australia had like a big celebration by the Prime Minister last week when they announced they managed to procure a single day of diesel fuel for the country. So, like, things are getting pretty gnarly in Asia. And again, the market can look through this if it says, hey, this is going to be a hit to Q2 GDP growth, and then things are going to start getting better, and so things will ease and improve. Okay, the market can look through that. If it starts getting to the point where, hey, it's not just Q2, but now it's starting to potentially impact Q3, this becomes problematic. And this is why I laid down back at the beginning of this, and I know I got a lot of crap from Mike and Tucker on this because I was like, yeah, if nothing's resolved by Cinco de Mayo, and they're like, Cinco de Mayo, like what are you talking about? Like, that's not even like
I don't know.
Like who's celebrating Cinco de Mayo? Like I'm like, guys, like this is it. It's not tax day. It's not Memorial Day. Like, find me something else at the beginning of May and fine. But ultimately, here's the problem. If you don't have a resolution by Cinco de Mayo, which again, I know, but just hear me out. Here's the problem. It takes time to get things spooled back up for production in all of the countries that have shuttered it in the Persian Gulf. On top of that, it takes a while to get all the boats that have not been going to the Persian Gulf back there in order to actually pick up the cargoes. Because if you own a tanker right now, you don't just sit outside saying, when are you going to let us in, guys? No, you say, look, I've got an asset that I've got to go make money on. I'm going to take it to the Black Sea. I'm going to take it to the United States. I'm going to take it somewhere else that I can pick up a load of oil and go with it, because I'm not just going to sit here waiting for Hormuz to reopen. So you got to get all these boats back. And the problem then is, look, you're at Cinco de Mayo. These boats, if they're coming from Europe or from the United States, it's 40 days to get back. Okay, now you're not at Cinco de Mayo. Now you're at Father's Day. Then you got to fill the boat up and get it to where it needs to go. Now you're not at Father's Day. Now you're what comes like 2 weeks after 4th of July. We need more holidays that I can like work with here. It is like
there's a big gap after the 4th of July.
Right? Is Grandparents' Day in like late July or something like that?
Bastille Day's in there, isn't it?
Yeah, they'll be storming the Bastille again if they don't have oil in Europe at that point. So this is where I'm going with this, is if you don't have things open in Hormuz by Cinco de Mayo, this is no longer just a Q2 problem. This now becomes a Q3 problem where you can't get the stuff that you need there. Can the market look through 2 quarters? Maybe, but it becomes tougher. And, like, heaven forbid that we're sitting here. What's 3 months after Cinco de Mayo? Cinco de August? Like, what's an early August holiday? Do we have any of those?
VJ Day in Rhode Island.
That's not a national day. That's
Chuck,
that's the smallest geographic state in the country. We can't go by that.
My instinct is to, when asked a question, try to offer an answer.
I know,
I'm sorry.
Our West Coast listeners are like, that's not even a real state.
Well, for a lot of reasons, yeah.
Our Rhode Island listeners are like, yeah, we're like in charge of this thing.
Not a real state.
International Beer Day on August 7th.
How many people
there before they were?
I know, but how many people from California do you think have been to Rhode Island?
I bet
that you can't just drive through it. You know?
Well,
that's what Connecticut's
probably not intentionally, no.
Like, we can just make fun of every state while we're at it. So, in any case, here's the deal. What would you say was early August?
August 7th, we have International Beer Day.
Okay, if things are not resolved by International Beer Day, you got another one?
How does that trump victory in the Pacific? Never mind.
The third
it's only celebrated in Rhode Island.
If you wanted to go...
It was celebrated.
This is international.
At one point.
This is International
True,
Beer Day.
Yeah, true.
If you wanted to go earlier, the third Sunday in July is National Ice Cream Day.
Do we have like any actual holidays? No. Or just like not even Hallmark will make cards for these holidays?
No.
Okay.
No, these are all the ridiculous
So
holidays.
this is the deal. Look, Cinco de Mayo, I've said since the beginning, is where the problems start to really happen. So these negotiations this week, they've either got to bear some fruit or you start to get we get to Cinco de Mayo pretty quickly from here. It's it's 15 days away at this point. So that's kind of what we've got going on in markets.
That's short term. Then there's the long term effect of higher risk premia because this could happen again.
Yes, there is, but I don't think markets are going to pick that. I don't think markets are going to pick that up unless you have a couple of years of this.
No, I just mean slightly more volatile stocks, maybe. And if you're in the business of managing money, the thing we do in our day job, that is something. It doesn't change the way you invest today necessarily, but it might change your long-term explanations. The world is more uncertain, if you like, than it was 6 weeks ago.
I think you only get to that point if you have a couple of years of problems on supply chains.
Fair enough.
So just because, again, we already went through a supply chain thing, and markets have does anyone look at markets over the last couple of years and say they're responding in any way to supply chain issues we had from 21 to 22? Not really. They kind of said that's a one-off, put it in the past.
Yeah.
If it doesn't become something prolonged, they'll say the same thing. That's kind of my argument on it.
Oh, I definitely agree with that.
They'll put it to bed and say, okay, that was a one-off, call it a day. So, if your state didn't get made fun of during that segment, please text us at 617-362-1385. We're happy to assist. Also, next segment, we're going to be talking about Gen X, who we forgot to talk about last week when we were talking about boomers and millennials. So don't worry, your day is coming. And if you have any other, group that you'd like us to make fun of as we discuss the economy, please text us 617-362-1385, and we will happily tell you what's going on with them economically.
Smart financial talk whenever you want. Find the Financial Exchange on YouTube. Hit that subscribe button and keep up to date on daily business news from New England and around the country. This is the Financial Exchange Radio Network.
Organization can make a big difference when life takes an unexpected turn. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Having your most important information all in one place may help the people you trust handle critical financial or legal decisions if a crisis occurs. We've written a new guide called Building Your Emergency Financial Binder. In it, we offer strategies that can help you coordinate the most vital details of your life, including key contacts, legal documents, and property information. Our goal is to provide you with a clear plan for the people you trust if they ever need to help manage a life-altering situation. Call 800-393-4001 right now and ask for your free guide called Building Your Emergency Financial Binder. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. When it comes to leaving assets to your family, simplicity isn't always the best approach. Cushing & Dolan are experts in elder law, and their new guide is called How to Leave Assets to Beneficiaries. Adding children as joint owners on accounts or property doesn't guarantee you can avoid probate. It may create serious unintended consequences. In this guide, you'll learn why leaving assets to your children may not always be the best plan. The guide also explains how trusts can be used to stagger distributions over time, help protect assets from creditors or divorce, and ensure your family receives your inheritance in a way that makes sense for your personal situation. Call 866-848-5699 right now and ask for your free guide, How to Leave Assets to Beneficiaries. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
It happens all over Massachusetts. In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
The Financial Exchange is now available every day from 11 to noon on SiriusXM's Business Radio Channel 132. Stay informed about the latest from Wall Street, fiscal policy, and breaking business news every day. The Financial Exchange is live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
All right, time for trivia here on the Financial Exchange. Friday afternoon, American Airlines rejected talks of a potential mega merger with United Airlines. A merger between United and American would create the world's largest airline and end a nearly 100-year rivalry. So our trivia question today, what is the oldest airline in the U.S.? Once again, what is the oldest airline in the U.S.? Be the fourth person today to text us at 617-362-1385 with the correct answer, along with keyword trivia, and you'll win a Financial Exchange Show t-shirt. Once again, the fourth correct response to text us to the number 617-362-1385 with the correct answer, along with keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Tucker, question for you on this.
Okay.
Is this, are you talking about this in terms of still operating?
I would assume major carrier is what this is entailing.
And are you including companies that were bought and absorbed into a major
You're
carrier?
going to have to take that up with the trivia department. I'm just the guy who reads it. I don't know, man.
Okay.
Sounds good to me.
Okay, I guess there's...
Bad.
I guess there's that. Okay, we got this piece from the Wall Street Journal. Sorry, Gen X, we looked at the data and you had it rough too. So last week we spent at least a couple days talking about whether the baby boomers or the millennials had it tougher. I obviously picked the millennials, and we ignored Gen X because that's just what everyone does. Everyone ignores Gen X. But not today. Today we focus on them and talk about, hey, did you have it hard too? Because everyone, why is it a badge of honor to say that your generation had it the hardest economically? Like, why is that a thing? Like what? How
Pretty
come,
self-explanatory.
No, like, don't you want to be better? Like,
Well, no, you've been through more than others. I think that's what it boils down to. You're a harder worker than other generations.
Kind of like how 80%
Your
of people are above average drivers.
Character is better. Like, it all
Yeah.
goes in that bucket.
Okay. So you've been through more, you toughed it out, and you made it. Mark, when we talk about this piece, as you are a Gen Xer, number one, how do you feel about us ignoring you last week?
I don't think we did. I was part of one of those
Who said that?
conversations.
What do you think about
I mean,
this?
I don't like these. It seems almost silly to talk about any prior generation having it easier than or harder than the present. In a growing economy, the last person standing always has it the easiest. Life expectancy is highest. General standards of living are highest in a growing economy, but there's serious bias in that calculation, obviously. So in some ways, it's not really an interesting question. I think you asked the right one, which is, what are we trying to get at here? Is it just bragging rights that you somehow persevered through a more trying economic or,
Sure.
I don't know, geopolitical environment? If so, it would be hard to compare a generation like mine that was not, Mike Armstrong made this point last week, never subjected to a draft, whereas boomers were, and obviously the greatest generation was too. At the same time, though, it's been challenging to build wealth because we've had to buy stocks at very high prices relative to earnings and had to buy homes at relatively high prices I say relatively because I mean relative to income. That said, those homes are bigger and equipped with more impressive amenities. Stock returns have been a little lower over the last 25 years as opposed to the 25 years before that. 9.5% is the average return in the last 25. In the 25 years preceding that, when boomers were starting to build wealth in earnest, it was 15%. So you could compound more quick. Your dollars compounded more quickly in the decades leading up to the turn of the millennium than since. And as I said earlier, and this is related, stocks have been over the past couple decades a lot more expensive relative to earnings. And if you think of stocks as the price of funding retirement, it's been harder to do for more recent generations than past generations. But those past generations would say, wait a minute, pal, I know people that died in their 40s and 50s because there are treatments available for diseases that were previously death sentences that weren't available in my time. So I find these questions tricky to answer because everybody's criteria is different. Plus, what's the point? Okay, you win the argument. Great, you had it toughest. What's for lunch?
What do we do now?
Yeah.
Okay, great.
You win what? How does that help me? You know?
I always come back to the place that I get to on all this when you're including everything, because you have to, you've got to it can't just be the financial piece, because if it's just the financial piece, there's literally a huge survivorship bias embedded in that, okay, boomers had it great financially, but as you said,
what does that mean though?
Here's the thing about boomers. They were still living in a world where when they were born, child mortality was exponentially higher than it is today. The generation before that, the silence, you still had, I think it was 20% of kids didn't make it to age 5.
Yeah, you had to worry about polio.
Right, this is stuff that you don't worry about the same way today. Yes, there still is infant mortality, but it is quite honestly 2 orders of magnitude removed from what it was.
You're having a heart attack, they called it angina. Take some nitrates.
Rub it off, rub some dirt on it, walk it off.
Right. I mean, you couldn't go to an urgent care center to get treated for infection that... Right.
My grandfather, when he was born, it was the same year that the Band-Aid was invented. Imagine that. Back then, you invented the Band-Aid and you could make millions of dollars. Today, you got to do hey, we figured out GLP-1 so people can lose. No, just here's a Band-Aid. You can't take, and this is why I always come back to, if you were to pick any other period from now to have kids, I don't think you're being intellectually honest.
It's just not really a serious exercise, Chuck. Serious researchers don't look into this other than trying to explain inequality and structural reasons why it might have blown up, why there might be a growing chasm, really, between the so-called rich and the so-called poor, however you want to define that. Other than that, And that could lead to something constructive. Gee, should we be adopting policies that mitigate inequality and reduce the possibility of, I don't know, populist-led turmoil that disrupts the economy and stock markets and stuff? Other than that, I don't really see how these little mental experiments are, or whatever you want to call them, are constructive.
But no, I'm a big believer in the world has never been, in the aggregate, as good as it is today.
Of course, right.
And today is the worst it will ever be for the rest of your life.
Hope, God willing. I mean, a Roman may have said that in 480.
In the aggregate, like the problems that we're going to be dealing with in the future are going to be smaller than the ones we're dealing with in the past.
Assuming the trend continues to go up, assuming we don't screw this up.
And if it's not the case, then, okay, we had a good run. What I'm most proud of for this segment is that in a story that was supposed to be all about Gen X, we barely talked about them.
Ooh, sitting right here, guys. Once again.
So,
sitting right here.
You're welcome. Let's take a quick break here, and when we return, we've got the trivia answer. We're doing Wall Street Watch, and then we're going to talk about, let's do private credit. That sounds fun.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Is it a stroke? Even if you're not sure, act fast and call 911. Signs can include face drooping on one side, arm weakness, speech difficulty, or not making sense when talking. Time is critical. A stroke requires immediate medical care, which starts as soon as the ambulance arrives. So if you see any sign of stroke, act fast and call 911. Visit mass.gov/stroke, sponsored by the Massachusetts Department of Public Health.
Sudden family emergencies can create confusion, especially when important information is scattered across different accounts. Hi, this is Mike Armstrong from the Armstrong Advisory Group. When something unexpected happens, loved ones may need quick access to legal documents or financial accounts that could affect your future. Our brand new guide is called Building Your Emergency Financial Binder. It'll help you learn how to organize the information your family may need one day. Everything from emergency contacts and identification documents to bank accounts and retirement plans. The goal is to create one clear roadmap so that people you trust can quickly find what they need if a crisis occurs. Call 800-393-4001 and request your free guide, Building Your Emergency Financial Binder. That's 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. When it comes to estate planning, many families focus on taxes, but understanding how your family will receive the assets you leave behind is just as important. Cushing & Dolan are experts in elder law and have a new guide out called How to Leave Assets to Beneficiaries. The guide explains decisions that may be problematic, such as adding a child as a joint donor on a real estate property, which could expose your assets to creditors or a possible divorce. You'll also learn how trusts can be used to help protect your assets and control when your beneficiaries receive their inheritance. Call 866-848-5699 right now and ask for your free guide called How to Leave Assets to Beneficiaries. That's 866-848-5699. Or request the guide online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled Building Your Emergency Financial Binder. Mike, when we talk about the type of information that should be in there, what kinds of things should people be including so that a loved one or family member can help to keep their finances in order?
Yeah, I think, on the financial side, it's what do I have and where is it?
And how do I get access to it?
Right, and so that can mean getting access to online passwords and things along those lines, but obviously how you share this stuff is extremely sensitive given the threat to being breached down the road. And so mainly it is, though, what is the snapshot of my financial, health, and legal life, and how do I format it in a way that people can actually interpret it?
And I think another piece there is that is also always changing. How do I let people know what changes I've made and when I've made updates to it? Because I might not have the same accounts that I used to.
Right, and the guy does lay that out of, hey, how do I document changes in here? Because you might not always have that old account at said financial institution. It could change, it could shift, you might retire, and keeping this thing up to date is critical. Obviously, the more stuff there is out there, the more complicated this becomes. And so as much of it as you can check off the list while you're still around and able to explain it is extremely helpful.
The guide, again, is titled Building Your Emergency Financial Binder, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. That phone number, again, is 800-393-4001, or visit armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets in negative territory to begin the week amid tensions between the U.S. and Iran increasing over the weekend. Last hour, President Trump said it's highly unlikely he would extend the 2-week ceasefire with Iran if a deal is not reached before it ends, and said the Strait of Hormuz would remain blocked until an agreement is finalized. Right now, the Dow is down 0.1%, S&P 500 down nearly 0.4%, NASDAQ down about 0.2% or 156 points, Russell 2000 up about 0.1%, 10-year Treasury yield up 1 basis point at 4.256%, and oil up 5% higher, trading at $88 a barrel. Shares in Marvell Technology rising over 4% after the information reported the chipmaker is in discussions with Google to build new AI chips. Meanwhile, building products distributor QXO agreed to acquire insulation products company TopBuild for $17 billion. TopBuild stock is surging 16%, while QXO stock is down by 7%. And sandwich chain Jersey Mike's has confidentially filed for an IPO. Blackstone bought a majority stake in the sandwich chain in 2024 in a deal that valued the company at about $8 billion. Jersey Mike's is the second largest sandwich chain in the U.S., trailing only Subway. I'm Tucker Silva, and that is Wall Street Watch. In the previous segment, we asked you the trivia question, what is the oldest airline in the U.S.? That will be Delta Airlines. Clifford from Nashua, New Hampshire is our winner today, taking home a Financial Exchange Show t-shirt. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Mark, we got private credit piece here. Wall Street Journal. Private credit is on the hunt for credit card debt. And what's going on here exactly?
Yeah, the upshot, well, it's a good question. I scanned it once, and I'm trying to pull out like the main point, hoping it would be something sort of new. And I look, private credit consists of non-bank loans to lenders who choose to not go to banks or can't tap public markets. And there's a lot of different types. It's a very broad category. It's like calling, go ahead.
You can have all kinds of crap that's in there. Like, as an example, the ones last year, you had Tricolor, who they were an auto dealer that had a bunch of loans that they had taken out for inventory. Okay, that's one example. I've seen other private credit that is a museum taking out debt to go and buy artwork. Like, and it can be everything in between. So when you hear private credit, it doesn't mean like a certain type of loan with certain features, with certain maturity, and it can be a bunch of stuff that's like not even close to being similar. Kind of like when we talk about stocks, like we don't just talk about like every stock that exists, because there's a huge difference between Apple And Tucker, what was the deli a few years back that was like running a
out of New Jersey, right?
The Jersey Deli fraud people.
It was definitely New Jersey.
Whatever it was, like that company and Apple don't have anything in common, just like a lot of different private credit types don't have anything in common either.
No, it's true, and they shouldn't, by the way. So the upshot is you've got private credit managers looking to diversify their portfolios, in this case using credit card debt. And it almost, I don't know if the desired effect of this is supposed to be to get people to sort of worry about it, like they're seeking out lower quality assets or something. But again, this is normal behavior.
I almost wonder if it comes across better, because one of the areas that has held up better not in markets, but you look at what's been going on with like default rates and things like that, and what's happening in the credit card space, and generally things have held up pretty well there. And so like I almost look at this and I'm like, okay, good. They're not just buying more of the same stuff and compounding the problem. Yes, it's true. They may end up making themselves entirely new problems through buying this kind of debt. But I don't know. I prefer to have, a little bit more diversification of funding source when you're looking at stuff like this.
Yeah, I mean the quantity of consumer loan balances held by private credit, as the article notes, has increased from 200 to 350. So
but that's over 7 years.
Yeah, over the last several. I don't have perspective. I don't know whether that's more or less than other types of loans that private credit, I'll say, originates. But what they're supposed to do is diversify their portfolios. They shouldn't just be lending to companies. They shouldn't just be buying debt of, say, private equity. Companies and stuff like that. They shouldn't just be buying real estate debt or engaging in or buying aircraft leasing related debt or royalties or whatever else. As you point out, there are lots of different types of loans that private market managers can make. Private credit in this case, and I would expect them to want to diversify their portfolios. So is this like big news? I
don't know.
What was the point other than that this particular category has grown?
Just so you know,
Yeah.
Mark.
I mean, an investor who's buying private credit is generally who's investing in private credit deals, is generally sophisticated and has a very specific risk and return profile that they're looking for to complement other stuff in their portfolio. This might be of interest to a investor looking for something to fill a very specific niche.
Folks, the Armstrong Advisory Group is hosting a retirement planning seminar. It's at 5 p.m. on April 30th at the Crown Plaza in Woburn. Topics of discussion: Social Security, Medicare, and retirement planning. There still is space available, but it is limited. So again, this is April 30th at 5 p.m. at the Crown Plaza Hotel in Woburn, Massachusetts. To sign up, few different ways. First, you can go to armstrongadvisory.com, click on the events page, and then register right there. You can also email contact@armstrongadvisory.com, or you can call 800-393-4001. Again, this is a retirement planning seminar focusing on Social Security and Medicare essentials. It's happening April 30th at 5 p.m. at the Crown Plaza in Woburn. And you can sign up by going to armstrongadvisory.com/events or calling 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
All right, we got a kind of interesting, kind of not piece from Barron's. I know I'm really selling it here. The worst year to retire wasn't 1929. The creator of the 4% retirement rule says it was 1968. And so if you're not familiar with the 4% rule, it's the idea that was promulgated originally by William Bengen, who said, look, if you are retiring and have a 30-year time horizon in retirement, a 4% withdrawal rate is generally safe so that you don't run out of money. And basically what Bengen looks at here is, 1929, you went through a big crash, which obviously impacted what you had there. But the problem with a 1968 retirement was you had almost 15 years of high inflation and low equity returns combined during that time period. And so that made it the most challenging time for the 4% rule to actually work the way intended.
Yeah, depending on the assumptions you make, you could come to that conclusion. We do our own little simulations here internally. And the way you do it, I'll be really brief here. You assume somebody retires in 1928, the first year for which we've got good data on stocks and everything else. And how did they do over the next 30 years? Did they run out of money if they were taking 4, 5, or 6% or not? And as you would expect when you do an exercise like that, and you can make a pretty good range of assumptions in there and still get to the same conclusion, because the bad periods were so bad that even somebody who was, say, conservative in their withdrawal rate or their initial inflation assumption was wrong-footed by the environment. Yeah, it was very bad to retire in the late 1920s. Not a big surprise. Stocks went down by 90%. They didn't recover until Ike was president. So we all kind of knew that. The assumption, the conclusion that the late 60s were a bad time to retire, that holds up if you assume people don't change their behavior.
Sure.
Presumably they did and would have, although they didn't have the number of instruments, vehicles that they didn't even have mutual funds, or at least they weren't widespread. Excuse me, there were mutual funds, but they weren't. You had to send your check by mail and stuff like that. So suppose we're on the cusp of a really bad period, a high inflation. That's possible with these oil price shocks and a Fed chair who seems to want to cut rates no matter what coming into office.
But even in the context of a retirement, and this is the thing that I come back to. Whatever's going on, here's the thing, if you look at it historically, whatever's going on at the start of your retirement in the world and markets, it's not usually what's going on at the end.
No, far from it. Never.
So this is why, even if you're concerned about X, Y, or Z today, and how is it going to affect my retirement? Honestly, it's not going to affect most of your retirement. It's the problems you are seeing. Think about it this way: if you retired in 1990. Okay, so the problems that you faced at the start of the 1990s were oil price shock, war in the Middle East, yada, yada. You then went through this whole tech boom. Then you had this housing bubble that came up. Then you had, a slow, it's not to say there weren't problems, but if you were nervous to retire because of, hey, Saddam Hussein is, invading Kuwait, that wasn't really the problem for your retirement. That's the point I'm trying to make.
Yeah, your strategy would have to be static. You'd have to be sort of very negligent to not. Go ahead, Chuck.
Forget about your strategy. My whole point is, whatever you're worried about at the beginning of your retirement, you really shouldn't be.
Well, but it could sink it though if you're overinvested in equities and you retire into a catastrophe.
I mean, of course, that could, but again, odds are that when you look at it, remember, here's where I end up getting to in most of these cases. When things get bad enough, policymakers change course. We've been through enough disasters in the last 30 years to know that that's the case. And I'm not saying this is not a stocks will always go up thing, but it's okay, whatever you're going through in markets is not going to be the thing that you're going through at the end of your retirement.
But sequence, a financial advisor, I think, would say sequence of returns, as the industry sometimes calls it, matters a lot. If you retire into some upheaval and you don't change your strategy, you could be invested too heavily in risk assets and equities, for
Which
example.
is why having a properly diversified portfolio heading into retirement is what you need to start.
So I don't think if you do the exercises that we do here and look at what happened if you retire, in 1928, then what happened to the people that retired in 29, then in 30, and did nothing. So they had the worst financial advisor in the world. They told them, stay the course, everything's fine. Well, those people were, forgive me, screwed. But that's not going to happen if you work with a competent professional. And that competent professional's verdict may be, this theme will not prevail throughout your retirement. You've got 30 years here. If the recent turmoil has taught you that you can't stomach the risk because you're no longer dollar cost averaging in.
Right, you can still end up being screwed by your own decisions that you make during, you can still end up with problems, My point is just, whatever you're worried about at the beginning of your retirement, it's not going to be the thing that you need to care about.
No, there'll be lots of other
like,
stuff to be worried about over the course of your retirement.
Right, exactly. There's always something new to worry about.
Right.
That's my point. Let's take a quick break. When we return, Stack Roulette.
Follow the Financial Exchange Show on Instagram and see what's driving the conversation about Wall Street and economic trends. This is the Financial Exchange Radio Network. Leaving assets to your family may sound simple, but you need the right plan. Cushing & Dolan's new guide is called How to Leave Assets to Beneficiaries. Protect your assets and control your family's inheritance. Call 866-848-5699 and request your free guide today. That's 866-848-5699 or request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Organization can make a big difference when life takes an unexpected turn. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Having your most important information all in one place may help the people you trust handle critical financial or legal decisions if a crisis occurs. We've written a new guide called Building Your Emergency Financial Binder. In it, we offer strategies that can help you coordinate the most vital details of your life, including key contacts, legal documents, and property information. Our goal is to provide you with a clear plan for the people you trust if they ever need to help manage a life-altering situation. Call 800-393-4001 right now and ask for your free guide called Building Your Emergency Financial Binder. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
In a heartbeat, you could be the difference.
Marc collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Get real-time financial insight as news breaks. The Financial Exchange is live on X. Watch the show and follow us for the most up-to-date business news you need to know. This is the Financial Exchange.
All right, Mark, what do you got for me for Stack Roulette?
Tucker pulled this piece for us, Chuck. I don't know if it caught your eye from the Financial Times.
No, it didn't.
AI, you're just being polite. Yeah, of course you saw it. AI boom poised to be massively deflationary. That's their adverb or adjective. It's an adverb, right? Yeah. Anyway, says Northern Trust. So what do they mean? This falls in the same category as some of the other AI hype that we were talking about that Warsh, the incoming Fed chair, presumably is a champion of. The idea that AI is not only going to increase productivity and related to that, not just cut the rate of inflation, but turn inflation. Well, they say disinflationary. Elsewhere it says deflationary. Let's just assume they mean disinflationary, which means a lower rate. I mean, maybe, Chuck, but there are also scenarios in which AI could be inflationary, leading to a demand for capital and increase in economic activity. Maybe productivity doesn't follow. And look, the point I wanted to make here is that in the long run, inflation is a result of too much demand, which is in turn is a result of the Fed printing too much money. There are no structural forces that make inflation higher or lower. In the long run, it's solely the Fed's responsibility to hit their target, 2%, 3%, whatever it happens to be. So take pieces like this, which you're going to see a lot of, and which often have an axe to grind. Take them with a grain of salt.
Is there anything worth taking from that piece?
The idea, keep in mind that if AI does boost productivity, that could allow rates to remain. If your concern is monetary policy, are there favorable consequences for monetary policy? Sure, we might be able to keep rates a little bit lower, run the economy at what would have been previously thought a hot level, because it's not hot. Much like, the 1990s, what am I saying? I should just say, Chuck, the late 1990s. Similar sort of favorable confluence of factors, but we don't know whether that's going to happen, and we don't know what the level of productivity is before AI boosts it. Maybe it was going to drop to 0, and AI keeps it at 1 or 1.5. We just don't know at this point, Chuck.
I want to talk a little bit about a story we covered. I don't know. I think this was maybe a year or two ago. Yeah, 2 years, back in January 24. We're going to just put a bow on this one. The 3 Southern California residents who had staged fake bear attacks on their cars to try to collect insurance payouts. Remember, this was the guy who dressed up in the bear suit and then wrecked these cars. But there was surveillance video, and so all the bear experts were like, "Hey, that bear is not moving like a bear; it's moving like a person in a bear suit."
Didn't the bear open the door with a door?
Yes, it was. Well, look, bears are smart. Bears aren't dumb, and they can open doors and stuff.
But in a human-like fashion.
But not that way, because they just don't move like humans.
Like he was going to work.
And then he used my favorite part is still. The pulled pork claws?
Yeah.
The guy used those to, rip the leather on the seats and stuff. And so it became very apparent quickly that, hey, this was not actually a string of bear attacks, but a dude in a bear suit. And so they are not actually going to have that $141,000 in insurance payouts. Instead, 2 of the defendants were sentenced to 180 days in jail in order to pay more than $50,000 each in restitution. The third is also sentenced to 180 days in jail, and restitution has not yet been determined. So this is why you don't commit insurance fraud, because you will spend 6 months in jail and have to pay the money back. You're better off not spending the time in jail and not perpetuating the insurance fraud. Just a thought. We'll take a quick break for the rest of the day. Back tomorrow on the Financial Exchange.
When it comes to estate planning, many families focus on taxes, but understanding how your family will receive the assets you leave behind is just as important. Cushing & Dolan are experts in elder law and have a new guide out called How to Leave Assets to Beneficiaries. The guide explains decisions that may be problematic, such as adding a child as a joint donor on a real estate property, which could expose your assets to creditors or a possible divorce. You'll also learn how trusts can be used to help protect your assets and control when your beneficiaries receive their inheritance.